Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Is the dead cat bouncing eggs or tennis balls? And more important, who wins that juggling act? And bully for small caps? Or are they going to experience some significant headwinds? And to buffer or not to buffer, that's the big question. The defined outcome ETFs are all the rage, but we're going to tell you what you need to know. And is your financial advisor too big to succeed? Forget about too big to fail. We know they can all do that. Any of the advisors can do that, small or big. The question is, are they too big to succeed? And the most affordable beach cities to retire in the country, the top 10, and Ameriprise is not budgeting on low cash sweeps at only 0.3%. They basically told their clients, peace off, we don't care. Sorry, we're not making any change. Every other BD on Wall Street has all had to change and start paying more because they were seeing a mass exodus. So the question is, will you see a mass exodus at Ameriprise? And could Ameriprise be the next big short? I don't know. That's pretty bold, just kind of giving the middle finger to your own client base. In any event, let's talk about the bully small cap for headwinds, because we've been talking about, for the last few months, we've been talking about this rotation, and we need broader diversification out into small and mid caps, and it can't just be these magnificent 7 or magnificent 8 or 10 or whatever. Can't just be these large cap mega stocks. We need, and that's what's happened. And we've talked about, if you take just a little bit of money out of these mega $1 trillion companies, just a 5% pullback is hundreds of billions of dollars. And if that goes into small cap, that's a huge boost to them. But do they have headwinds? Now, a lot of these articles are in the show notes. You can go read them yourself. And it talks about small cap outperform large one. What's next? And it talks about, and I like it because the guy does actually use some technical analysis to talk about small caps and how they're heating up. But here are a couple things to keep in mind. Large caps are generating earnings growth, and a lot of small caps are not. Portfolio managers hide in highly liquid stocks because they can't do a lot of small caps. They got too much money. It's hard to buy in a small cap. 40% of Russell 2000 companies are not profitable, and they greatly depend on a growing economy. Okay, so if the economy slows, they could hit the skids. And then large caps continue to benefit from passive ETF investing, whereas RK, well, they do kind of, maybe not as much, but they definitely also participate. So I don't quite agree with that one. Anyway, he basically says while this rotation is certainly could continue, he said there are many headwinds. Well, you can read that and you can check. And now, to buffer, this is the one I really want to get to, and this is to buffer or not to buffer. Folks, I've been talking about this for years about indexed annuities, which are really a fixed annuity, but the interest crediting is based on the performance of the S&P 500. But they put a cap on it, so it's 8 or 10% cap. You can't make any more than that, but you're guaranteed not to lose any money. And they had big commissions and all that kind of stuff, but they really comforted investors because they say you could get most of the gains in the market, but none of the downside. The problem is you don't get most of the gains. That's a big lie. You get roughly about half the gains of that. Okay, so they don't do as well. But these new ETFs are now trying to steal market share from the annuity market, and they're going to. It's going to put significant pressure on these annuity markets because now they can basically create an indexed annuity where you just buy it, you pay 0.69 or 0.7% management fee, and you just stick it in there. You don't have to have surrender penalties. So it's going to really affect the annuities. But here's the thing. So I'm just going to give you an example of one of these because it makes people feel really good. It's got a 0.69% management fee. It's capped at 9.8% of the S&P that year. And remember, you got to pay the 0.69 management fee. So to get that 9.8, you got to make 9.8 plus the 0.69, so roughly 10.5, and you get that 9.5. I'm just going to use round numbers, right? And you got 100% downside protection, so you can never lose money. That's how they hook you. That's how you like it, right? Most of the upside, but none of the downside. But if you got a 20% year or 25, then you only get 9. That cuts it. But here's the problem. You've got to hold them point to point. You got to hold them for a whole year. And then you simply roll it over to the next buffered ETF. Hopefully it's still 9.8. Once they attract a lot of money, like the indexed annuities, they'll probably drop that to 8 once they get everybody hooked on it and liking it. But here is do the math. So in any 1 year period, if you know that 9.8 might be enough, you don't want to risk the money, and you know you're going to need that money in a year, that's fine. But if you're doing it year in, year out, and you're planning on rolling it over, think about this. In a year where you don't make any money, fine, you make 0. In a year that the market makes 7, you get 7 minus the 6.9, so you roughly get a little over 6, right? And then the market makes 20 and you get that 9.8. So 0 plus 6 plus 9.8, it's about a 5.2 return. So these returns significantly dampen the upside, but that's not as obvious on the surface until you really look into it. So it's really, in my opinion, I would look at these buffered ETFs as like a enhanced CD. It's like a CD rate. It's 5-6%, but you got a little bit of opportunity to maybe make a little bit more. But folks, don't think that you're going to make 9.8% year in, year out, or even close to that. Over the long term, these buffered ETFs are just like the indexed annuities. They're mathematically made to pay you about 6%, maybe 6.5% over time, and they're going to keep the rest for themselves. So in any event, that's another one. And then again, this Ameriprise, they're not going to pay up on the cash sweeps. You can read that for yourself. And then there's another one that talks about time to add duration to bonds. You can certainly look at that. And then home sales crashing. And then lastly, this wirehouse veteran sees risk to clients in these RIA behemoths. And basically what he's saying is, forget about this. Are these big mega RIAs? Are they too big to fail, or too big to succeed? Excuse me. In other words, all of a sudden you lose the personal attention. Basically it becomes a pie charts are us. It becomes like a glorified Fidelity or the Schwab, portfolios, whatever they do it, where they take that sector ETFs and they create you a portfolio of sector ETFs. And then they kind of maybe sprinkle a couple stocks in, but then you just set it and forget it. That's what the brokerage firms do. And folks, by the way, even at Schwab, Fidelity, when they do those pie chart ETFs or mutual funds, they benefit. They're not a fiduciary. They're not a fee-based only fiduciary advisor. There's a conflict of interest. That guy's a broker, and they put you in funds that they may get paid more on. So there's conflicts of interest. Point being is these huge mega RIA firms are starting to homogenize and look like the big Schwabs and Fidelities, and they're set it and forget it pie chart portfolios with occasional rebalancing to make you think there's some active management. Folks, if you're just going to do a pie chart and set it and forget it and occasionally rebalance, you don't need to pay somebody to do it. You can do a little research online. I can show you how to do that in 15 minutes for free. It's not that difficult. So you've got to remember, everything has risk, and the risk of not losing money, managing risk to not lose money and not have big drawdowns is very important. But there's also a significant risk to capping the upside. You got to remember that. They don't tell you about that. in any event, we'll go over that more in depth later as we get more, because they're building these out all the time. And I just don't want you to feel like that's an easy way to do it and you're going to get market-like returns. Folks, it's not going to be any close to market-like returns or like the S&P. All right. And finally, we've got the most affordable cities, beach cities to retire in, the top 10. Don, your state is the winner with 6. South Carolina had 3. Alabama had 1. There's not a single one on the West Coast or in the Northeast. I wonder what the common denominator is. Anyway, I wonder why Texas is also... I know. I wonder why Texas is not on there. I guess our water isn't just clear enough. It's a little bit murky with our big continental shelf, but the fishing is great. In any event, folks, we got a lot of stuff to go over. I do want to do one thing in the mailbag, and then we are going to hit the ground running and go into the markets. And we're going to talk about, is this a dead cat bounce? We're getting a nice big bounce today. Are we playing with first of all, the eggs and tennis balls? Those are your stocks, which are going to be the ones that bounce off the pullback and not just go splat. So you want the tennis balls. Number one, you want to determine whether this is actually just a dead cat bounce and the market's going to roll over and it's just a relief rally, or whether this is actually a firming up at held support and it's going to move higher. In that case, you want the tennis balls, not the eggs. And we'll talk about that. But we got a great mailbag question. The reason I want to go over this is pertinent to a lot of people. And actually, there's an article in the mailbag. I had already put this in the mailbag when a client actually asked me this because it's pertinent to them. And it's Ed Slott. Final RMD regs for create unnecessary complication. These are with inherited or Roth IRAs. Okay, so the IRS just clarified this for any inherited IRAs from 2020 on. Any inherited IRA that was before 2020, 2019 or before, you just take it out over your actuarial life expectancy once you inherit it. Once it's 2020 and newer, they have what they call the 10-year rule, where you had to take it out over 10 years in any amount. You could take it all out that very first year. You could take it all out in year 10. You could take it out a tenth, a tenth, a tenth, a tenth over 10 years with whatever's left, taking it out in that 10th year. So whatever was left had to come out in the 10th year. But then the IRS decided to clarify and interpret what they thought Congress meant. And we just got that hot off the presses 2 days ago. All right. So this is 723 SP. Hi, Dan. Hope you were well. We have an inherited IRA in L's name in our Schwab account from a few years ago. Can you review and determine the withdrawal requirements? I know some need to be withdrawn within 10 years. Thanks, SP. Me, S. I'm very well, thank you. I trust you and yours are well too. Actually, S. Since the new law passed, at first, any inherited IRA where the decedent passed after January 1st, 2020 must be withdrawn 100% within the 10-year period in any combination in any years. We literally just received an updated clarification for inherited Benny IRAs, that means beneficiary IRAs, if the decedent had already begun taking their own RMDs, their own required minimum distributions, because they had already hit their 70s when they died. So folks, once they hit their early 70s, the people that originally started the IRA, they have to take required minimum distributions. They have to take that out. So if you inherited an IRA from one of your parents when they were in their 60s or 50s, and they haven't started doing automatic annual disbursements based on their life expectancy, then you're still under the 10-year rule. You can just take it out in any combination over the 10 years. However, if your parents had already started taking RMDs, okay, it said the inheritor, the person inheriting the money, would also have to take out RMDs for years 1 through 9, with the remaining emptied out over 10 years. So if you had a $100,000 IRA and the minimum requirements were only 4,000, 5,000, 5,500, 6,000, for the 9 years. So it only ended up being maybe $30,000, $40,000. All the rest, the 60,000, would have to be emptied in year 10. Now, however, because the IRS missed the first years, meaning 2020 through 2024, they went ahead and they waived the RMDs for 2021 through 2024. Therefore, you only have to take out RMDs from 2025 to 2029. So for those 4 years, and then 100% of the remainder has to be taken out in the following year, December 31st, 2030. He said, and your mother-in-law passed in 2020 and was already taking her RMDs. So now, this is the minimum you need to take out in years 2025 to 2029 to be compliant. But you may want to take out more annually so you don't have a big tax hit in that final year and push you into a higher tax bracket. This would depend on your current and probable future earnings along with any passive income. So again, if the decedent hadn't begun taking money out, you can do whatever you want. You just got to get it out over 10 years. If they've already been taking their RMDs, you've got to do RMDs starting next year for those 4 years and then take out the remainder. Now, you could always take out more than the RMDs. So folks, if that final year in 2030 is going to make you take out a big chunk of money, maybe you take out more than your RMD next year. Maybe you take out twice as much and you spread that out so you can manage the cash flows. In any event, there's been an update for any inherited IRAs where you have already been taking required minimum distributions and the person passed in 2020 or afterward. So that is an important update, and that's not what they were saying earlier. So I definitely wanted to get the word out. All right. Now, with that, what I want to know from the team and from Don is the market was just smooth sailing, not a problem. Everything's nice, especially the large cap, big tech. And then about a month ago, things started getting a little tougher. Things started getting choppy. Things started getting actually a little longer than that. And then all of a sudden, we had a pretty big rotation into small caps. And we've talked about on this podcast how you take just a little bit of selling from those mega caps, adds a lot of money into small caps if it doesn't go to the money market. We also said that we needed more breadth, more participation with these stocks for a longer term rally. So the question is, did this pullback, and we're having a big day-to-day update, is this finding support and holding, or does this look like a dead cat bounce? Are we playing with tennis balls or eggs, Don?
Great question, Dan. And the key turning point was actually 2 weeks ago Thursday when the CPI report came out. I had this flagged with this little arrow here, and that was the day that I'm showing the S&P 500, which continued higher for 3 days. But look what the NASDAQ 100 and big cap tech did on that same day. That was the top for them. It wedged for 3 days and then had a massive gap down on 7/17. But look what small caps did. And this also applies to mid caps, and it also applies to the beginning of outperformance for the equal weighted S&P 500, the RSP. There's the downtrend line. There's the date for CPI with the big gap up, continuation higher. And now let's go to a 60-minute chart. You can see for 8 days, basically, we've been in this very nice tight range between 215 and 225 on the IWM. That's the main ETF proxy for the Russell 2000. Got to the top of it earlier this morning, pulling back nicely. And this looks like it wants to go higher. We had PCE inflation data come out this morning that was in line. And the setup is there for small caps. Let's show mid caps. They haven't held the breakout the way small caps have. You can see it initially broke out, but that's also in this 8-day tight range here. You can see it had the gap up, continued higher for the breakout, but has pulled slightly back into the base. The base with the pivot being around this 558, 34-ish level, and we're slightly above that today. So recapturing it, we pulled back nicely to the 21-day moving average. That's the level we always want to see hold. But most importantly, look at the relative strength line on MDY. Look at the relative strength line on equal weighted S&P. Look at the relative strength line on small caps. If I type the right ticker, small caps. This is where, and you mentioned on your intro into this, this is where money has been flowing. And then the question is, with the sell-off in the NASDAQ 100 and the S&P, yesterday we had a negative reversal late in the day and a break in the close below the 50-day moving average. First one since back in the end of April. But we've reclaimed that level today. And this makes yesterday's low on the S&P an extremely critical level to keep an eye on. Let's go to the NASDAQ 100, which is acting much worse. And look at the big volume bars of selling on the NASDAQ 100 ETF. You can see the break below the 50-day, a lower low, a bounce about in line with the S&P today, slightly below what the S&P is doing. We're at least trading in a tight range. Things got the range, the ATR, average true range, on the S&P is a little less than 1% right now. Yesterday, it was almost 2%. So when volatility increases like that, it's more like bear market action, where almost casino-like action, where you have big swings. We had a big move down yesterday morning, that being Thursday, a huge move up late morning and early afternoon, and then gave it all back for the rest of the day. This is not the type of action that you want to see. It's not bull market action. This type of volatility just really doesn't happen in bull markets. They happen more like the smooth uptrend that I'm showing here. That's the expectation, a smooth uptrend like started last November and went into March before a pullback. So right now on the NASDAQ 100, we're about 9% off the high. We're about 4.5%, maybe 4% now on the S&P 500, which is nothing. That's just a garden variety pullback. As long as we hold this 50-day moving average, that's really going to be the key level, because then you go down and you start testing the 100-day, then the 150-day, and then the 200-day moving average. And the 200-day moving average is quite a bit down, 9.7% from where we are right now on the S&P. So that'll feel quite painful if we start visiting that. The way we handle it in-house, very easily, following our rules. We discuss them every night in the video. We broke the 21. The slope of the line on the 21 rolled over. We broke the 50, but the slope is still uptrending, and we reclaimed it today. So what we're looking for is what happens if we pull into this declining 21-day moving average on the S&P. That's the upside resistance. And then the downside support should be the 50-day moving average and the lows from Thursday. Those are the key levels on the way down. Now, note what happened on the NASDAQ 100 earlier this week when we ran into the declining 21-day moving average. Epic fail. And we paused there. We had the big gap down the next day. We haven't even tested going back to the 50-day moving average. Note the relative weakness that we've talked about that kicked in 2 weeks and 1 day ago with that top when the CPI report came out. So the small caps clearly outperforming right now, mid caps also, and equal weighted S&P also outperforming. The weakest, the NASDAQ 100, and just take a look at NVIDIA, which was the leader in the market. It also broke the 50-day moving average. Broke the 21-day. What happened when it came up into the 21-day? It found resistance, gap down the next day. The slope of the line rolled over, and this is very similar to the NASDAQ 100. This is acting as resistance on the way up. We still haven't touched the 50-day moving average to test to see what happens when we get there, but the 50-day is still upsloping. It's still in an uptrend there. We've hedged our NVIDIA position. We have decent gains in it. In some longer-term taxable accounts, we've got gains for 100%, 200% in it. So we don't want to blow it out if this is just going to be maybe a 20% pullback. and it should find support at the 20-week moving average, which is where it did yesterday. Let me go to the weekly chart very quickly. That's the green line here. Found support for NVIDIA at the 20-week moving average, and the NASDAQ 100 also support right at that 20-week moving average. So that makes the lows of Thursday even more critical, because it's not only a low that looks like a shakeout low, but it's a low that bounced right at a key level. So you want key levels when they hold as support to continue to hold. So you can't really see, I don't have a 100-day moving average on this chart that of the NASDAQ 100, but Thursday's lows are key, and then see what happens when we test the upside on the NASDAQ 100 and the S&P 500. But I do have a question for you. I'll let you ask me any questions about this, but then I've got a question for you about those buffered ETFs before I forget.
Yeah, go ahead.
So you said that you have to hold them for a year. They say they're an ETF, so it's going to show if you buy it in your brokerage account. What happens if you click on that and click sell? What actually happens? Does it not let you sell?
I don't know. I'd have to ask them. I think you probably get your principal back. I don't think that you get a partial gain for the year. That's a good question. But I know to get from the buffered ETF standpoint, where they're going to pay you a whatever the contractual thing is, the 9.8 cap, if the market goes up for that, you have to hold it for that year period. They've got some that are 6 months, some that are a year. That's why I went to listen to the presentation, because the way they're couching it, the way that they're proposing it, is these people that are scared, that don't want to take the risk. They want to make market-like returns, but with no risk. You would just buy these every year or 6 months, and then you would roll them forward and roll them over. Well, the problem is you've got, if you don't manage downside risk like we do here at Revere, our portfolios will go down some, but they're not going to crash like the market. Say we've never had a bear market. We've got sell discipline. So you want to manage risk and you want to manage downside, but you also have a risk when you cap upside. If you cap your upside too much, you have run the risk of not making enough money to retire, right? If you don't have a high enough return. And so it sounds good in any 1 year. Like right now you think, well, God, valuations are kind of high. I'm scared, but I want to be in the market. It keeps going up. I can buy this. And you know what? I'm happy with 9.8 for a year is good enough for me, even if the market makes 15, but I can't lose any money. That 1 year time makes sense. And I'm going, okay, that's good. But when you chain link it together and rolling them together, see, it's not each decision is independent on itself. They actually, just like compounding, Don, compounding works. So if you're capping it, those caps really will deter, because you're going to have a few years where you don't make anything. And then you're going to have a few years where you only make 5 or 6. What people don't realize is on the S&P, when they say, the long-term average has been 8.2, but it's a little higher because the last decade or 20 years with the Fed being so active and rescuing the market some, that longer-term average has gone up a little bit higher. But the point being is you don't get that average or anywhere close to that average without having some big 22, 25, 20% up years. I mean, if you capped your returns at 10% every year, then your average long-term return is going to be around 5%. That's just the bottom line. They really gloss over that when they talk about these. That's not, they always focus on the downside protection, and they talk about how you can share in the upside, but people don't realize, because most people in their mind, they think, well, the market only averages, 8, 9, 10%. So if I'm getting 9.8, that's almost the maximum. I mean, they're thinking of the average 12%. They don't realize that average is because you had a couple 25% years, it really pulled up the average, right?
Well, conversely, you've also got years that are minus 30%. So, and you don't get those either. So I could see the attractiveness of it, but if the market's down 12% and you're down 0, you're happy. But if you were in T-bills getting 5%, you're not happy. These are a lot more attractive when T-bills and T-bonds were paying 1% and
0,
under
yes,
than the
yes.
4 to 5.5% that you can get now. So
Yes.
All right,
There
good.
is,
So any questions
but I'm
on
just
the
saying,
market?
yeah, I'm just saying if you manage risk, if you manage, look, we've actually done very well and made very similar market-like returns as the S&P, but we've had no bear markets. Now we do have some drawdown. You don't have zero, but you also have a much higher annualized long-term return than these structured ETFs. That's what I'm talking about. If you manage
Right.
returns effectively, you can make better returns in these buffered ETFs and you can make market-like returns, but you don't have to go through all the pain. But it takes work and it takes active management. So with that, I'll let you tell us, Don, how do you do that?
I think I just did tell you.
I know.
Any questions on what the markets on the
No,
outlook there, Dan?
that was very good. So what are we like? What are we looking at? Where is the rotation? What stocks and what sectors look good?
Well, why don't we go over to Ted and discuss that? What do you think?
Teddy Bull.
Yes, Don. So I'm going to talk about what we see as our top opportunities in terms of the sector rotation that Dan and Don have been describing early on this podcast. And this is just another follow-up to what I did last week about IWM, MDY, so small caps, mid caps, XBI, biotech, KRE, regional banks, and XLF banks. And before I talk about the technicals, I mean, it hasn't changed too much since last week, except that they're holding up really well and flagging and digesting their thrust extremely well. I wanted to give some context fundamentally on why we believe that these sectors are the next areas where money will flow into. So coming into this year, 2024, the market was pricing in 6 to 7 rate cuts. We thought inflation was done, but inflation stayed sticky in Q1. So the Fed decided to not cut rates. And at one point, almost 0 rate cuts were priced in for the year. But last quarter in Q2, we saw 3 positive pieces of inflation data. And actually today we saw just more data from PCE signaling to us and the Fed that inflation is coming down, is softening, and same with the labor market. And I was listening to Howell talk in a podcast, and he talked about how the Federal Reserve is seeing encouraging signs that inflation is coming down, and they are gaining confidence that the first rate cut may or may not come in the near future. And so that's precisely what these sectors are starting to price in and discount. And on top of that, the Fed swaps have priced in 100% probability now that the September meeting, we should see a 25 basis point rate cut. And so, Don, can you pull up XLF and then KRE afterwards? So XLF, we recently broke out into all-time highs. And Don, if you could pull up the weekly real quick to give a bigger picture view. When a sector or stock breaks out into all-time highs, when the S&P and the NASDAQ are pulling back, that's just showing that it's yelling at you that it wants to be bought, or at least you should be paying attention to it. So if you return back to the daily, you broke out into all-time highs, and then we came in a little bit with the S&P and the NASDAQ with their pullbacks. But we retested that previous all-time high area, and now we're looking to be a tennis ball. To have that official tennis ball confirmation, we need to take out those highs, but it seems like we're shooting for that. So definitely great action here. And then if you go to KRE, we're in this bottoming base in stage 1, and off that CPI print, we gapped up. And I call it a macro EP, or just macro catalyst gap. And after that, it's been history ever since. Just continues to drift higher, making higher highs, higher lows, and just trending along the 8 EMA almost perfectly. And you see that RS line, it broke the downtrend line and exploded higher with the price. So it's just confirming the strength, the sheer strength in this sector right now. And another just variable that we're considering is we noticed that the yield curve is steepening. And what that means is you've seen all the pundits, the news talk about the yield curve inversion, which is when the short end of the curve yields higher than the long end. So what we're seeing now is steepening, which means it's uninverting, where the long end of the curve is rising faster than the short end. So we're starting to flatten and correct that inversion. And that is positive for banks because traditionally banks borrow from the short end of the curve, or borrow at the yield at the short end and then lend on the long end. And so having that inversion is really positive for banks. So KRE, XLF, two sectors that are high on our focus. And we actually have FAS. We bought that yesterday. So we have participation in there, but we're still looking at this regionals area as well because it's even more powerful. Next, can you bring up IWM? And afterwards, I'll pull up midcaps. Pretty much similar charts. Talked about it last week. All these charts, by the way, are above their all-time high anchor VWAP. So everyone's at a profit right now on average. And we're just seeing great strength here as well. Same day with regionals, gapped out into new 52-week highs, pushed higher for a few days, and pulled back, found support at the 8 EMA. We're looking to be a tennis ball here, not in pick. And that's exactly what we want to buy. And rates, lower rates is what the market is discounting, and that's great for small caps because I've said previously on the show that I think 60% of these small caps carry debt. And so having that lower interest rate will just lower that burden for these companies. And also many of these companies are trading on future growth. So having that discount rate lowered is better for these institutions who use valuation models to price these stocks. Similarly for the midcap, if you could pull up MDY, Don, we broke out to new all-time highs and then we pulled back in and we're starting to turn around again. And just really constructive action here. The RS line broke the downtrend line as well, confirming with the price. And as Don pointed out, and as I talked about in a video as well, that RS line made a new high before price too. So that's another little subtlety that we look at in our analysis of charts to give us maybe an indication that price is going to catch up with that RS line and make new highs as well. And then finally, XBI. Thesis is pretty much the same here. Biotechs are essentially just research labs, research factories that carry on a lot of debt. They just go public to raise money to fund their projects. And with higher rates, they have to pay more interest, and that just definitely takes a hit on these companies. So when the Federal Reserve lowers rates and they start discounting lower rates, they're acting really, really well now. And we're making new relative highs here as well. And the RS line is confirming that. And then finally, just a bonus section away from these interest rate sensitive names is my Bitcoin thesis that I've talked about previously on the show. I was definitely, well, in hindsight, I was early. What we needed as of now is we shook out the lows of the base at that 56,500 level. I've talked about this on the videos. We reclaimed that and quickly moved higher. And this is really reminding me of that NVIDIA undercut reversal back pre-split in that 400 to 500 area where it started to look like a head and shoulders, and we undercut that neckline, found support at the 150 day, and then ripped back to the highs of the base. And that is kind of what is starting to happen here. And so I'm just watching this right side of the base build and find it really constructive. And then these past few days, we also have the Bitcoin conference, and then Trump is going to make history tomorrow, being the first president to appear at one of these conferences to endorse Bitcoin. And some people say that he wants to support Bitcoin being part of the strategic reserves of the United States. So having one of the leading countries in the world adopt Bitcoin is really powerful for this asset class and its legitimacy.
Good stuff, Ted. So how concerned do you think we should be about this big Trump appearing at Bitcoin at being a sell the news event? We really won't know until Monday. Because it's happening over the weekend, right?
So I would say, there's definitely a chance that it could be a sell the news event. And that could just, if you pull up a NVIDIA chart, that's kind of the precedent I'm using. It could just create that next contraction to finish building the right side of the base. Maybe we run into the highs here. I think that's 43 on your chart. And then it's a sell the news event, pull back a little bit, finish building the handle, and then perhaps stage a breakout. Oh yeah, and the part of the video I'm talking about is kind of squished together. It's in that huge 6-month base all the way back there, but if it's too much of a hassle to bring up that time frame, if you change the date to maybe February 2024, we could probably get a better picture. And of course, these charts aren't perfectly similar. It's almost impossible to have exact copy in price action. But right there, Don, when we started having that head and shoulders, you see where we shook out that low of the base and then found support in that 150-day moving average area, and then we ripped all the way back into highs. That's kind of the area I'm starting to look out for, and then before finish building its base for the next 1 to 2 months.
Ideally, a clean breakout the way NVIDIA did over 100 pre-split is
right.
Is the easiest trade, the least painful if you get a clean breakout and it continues. I mean, everybody will say you're looking at that on Bitcoin, it can't go because everybody sees it. Well, everybody saw this breakout on NVIDIA too, and it just kept going, and that was the big run. All right. Thanks, Ted. Let's go ahead over to Connor.
Yeah, so the first trade I want to talk about is on the semiconductor ETF. I played this via the 3 times levered bear ETF, and this is ticker symbol SOXS, SOXS. And I bought this on July 16th at 19.6 a share. And as you can see on this chart, July 16th was a confirmed lower high. And after you get those outside negative reversal candles, that's usually a red flag. And I saw weakness in the wedge up in the body of that candle. So I put that on. And as you can see, the following day, all semiconductors gapped lower. This was largely due to Biden and had some news on chips overnight. ASML had a very weak guide, and that brought the whole sector lower, and they gapped below the 21-day. And so I sold some into strength at 22.51 as with shorts. You never want to overstay your welcome too long, and they can move short squeezes can be vicious. So when you're getting multiples of your risk, especially on a short, I like to be pretty quick, take profits. And then the following day on the 18th, it gapped lower again right into the 50-day. And that's when I sold the rest of it as it was starting to bounce at the 50-day. And, it was then around 8% off its highs. So the risk to reward to the short side from my analysis wasn't as good there. And as you can see, semiconductors have continued to stay weak. But the trades closed, it was sold for a gain. And so that's the semiconductor short. A losing trade is Apple. So July 23rd, I added on to my Apple position at 224. And the reason for this add was it put in a reversal candle off the 21-day. And you can see how it started to pull back to that 220 previous high. So the risk to reward was pretty good there, especially with the 21-day. And adding there gives you a clear line in the sand for when you'd be wrong. And another part of the analysis that I liked with Apple is that it was showing relative strength to other tech. NASDAQ was at that moment was down around 6% off its highs, and Apple was showing relative strength. So the thought process was if the NASDAQ was going to bounce, I'd expect Apple to lead. And then the next day, it gapped lower below the 21-day, hit my stop, and that was that. It was a pretty quick loss, and especially with ads, when you're adding on a weakness, on a pullback, the expectation is for that to bounce. So if it doesn't bounce, then I knew I was wrong very quickly. And it's moving lower now. Overall, still looks all right, but want to see this one get back above the 21-day. And then a new position today that we took was ServiceNow. And so some of the reasons behind this one is this was the other day, yesterday it had an earnings gap. It had strong earnings, strong volume, and gapped out of a huge base. And that's picture perfect gap out of a base with a catalyst, which was earnings. And just some other things is that this is a pure can slim stock. Current earnings are over 25%. They've been showing annual earnings of growth of 25%. They did say in their earnings call they're introducing a new AI powered products. And if you look at the supply and demand of this one, it's breaking out into new highs with an up-down volume ratio of 1.5. Leadership, look at all the other software stocks. This is your clear leader. And then this is just tons of institutions own this name, and it's liquid. And with all the fundamentals, I think this is a favorite for big institutions. And then another part of the analysis is that the QQQ has pulled back around, at the lows, it was around 9% off its highs. So when the market pulls back, our job is to look for the relative strength, what names are holding up the best. And if the market starts to rally, your expectation would be the stocks that were holding up the best, they would get even more momentum to move higher with the strong market behind it. So that was ServiceNow today, and as always, this could foul the breakout and stop us out, but the risk to reward is really good here. With it hasn't really broken away from that base, and it's not extended. So this one will be a good one to watch in the coming weeks. And on the topic of breakout sometimes looking too obvious, like Don mentioned, NVIDIA looked super obvious, SMCI looked super obvious. ServiceNow is a pretty obvious base breakout, but when big institutions want it, it doesn't really matter if it's obvious. It just matters if supply and demand, if people are buying, it's going to move up.
Absolutely. Good thing about today is it had a little shakeout below that 820 level right here, which corresponded to where it broke out intraday yesterday. So, and it's holding that level. So 820, a pretty key level today and going forward. And then, of course, you want to see it take out yesterday's high. You mentioned Apple too. I think there will be some reckoning next week with earnings being reported by Microsoft and Apple and Amazon next week. I think we've got Microsoft on Tuesday and Amazon on Apple on Thursday. So look for some
big week,
some fire there, whether that resolves to the upside or the downside. Everybody is really parsing. Everybody that's an AI player, everybody's really parsing their earnings reports now for any sign of a slowdown, because the growth has been priced into these names. And as Connor mentioned, with that ASML gap down, that triggered the whole semiconductor industry to really start their correction when that hit. So that's definitely the key for next week, Dan. And that'll take it from the tech side. You can go ahead and take us home, Dan.
I appreciate it, folks. And like what Connor was saying, we always say at Revere, it's okay to be wrong. It's not okay to stay wrong. If a trade is going against you, clip your losses quickly, keep them small to single digit, because compounding works both ways. And by the way, when he says he's wrong, the setup is there. It's right. It's a good trade to take. And then if the market or that stock changes character, then it can turn into be wrong. If that same setup happened again a couple weeks down the road and that was still one of our favorite stocks, we take that same trade. So it's not really necessarily that you're wrong. It's just that the market or the stock changed character, and so you had to make adjustments. We're constantly making adjustments and managing risk for the portfolios. That's what active management is all about. It's not about a pie chart where you rebalance on some arbitrary date. A lot of times that's picking the flowers to water the weeds. We do this on a daily basis. We look and see where we need to clip the weeds to water the flowers. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can put your email and name in there. We're not going to reach out or send you a bunch of spam. You'll get our daily market insight video every night the market's open directly into your inbox. And you'll get this podcast on Saturday morning. If you go to YouTube and you just search for Revere Asset, just Revere Asset, and hit subscribe, you'll get this podcast as soon as Zach posted, our producer. It'll probably be out at 12:30 or 1 Central Time before the market closes. That's how our stock nerds do it. And then you'll get our other daily market insights when they come out. You can also email any of us, Dan at revereasset.com, Don at revereasset.com, or Hunter or Ted at revereasset.com. And you can always call us old school at 855 Real Wealth. Folks, we'll talk to you on your money, not their money, your money.
It's not how much you make in the market, how much of that you can keep.